This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So our final section to go through and look at in this ongoing chapter of non-current assets is investment properties. Okay. The accounting treatment of investment properties is relatively straightforward. It is the identification of an investment property that is a little bit more challenging. Okay. But to start off with, I'm thinking about identifying what an investment property is. It is quite literal, but there are complications. So literally, investment property is property. Okay, yeah. What do we mean by property? We'll go back to what we've seen in IS 16. Property is land and buildings. Okay. But the key that distinguishes investment property from property under PPE is that this property is held for investment purposes. So that means that we're either going to go through and earn rentals. So if we're being specific, that's whereby we earn rentals under an operating lease. I'm not going to talk about the specifics about finance and operating leases just yet. But if it's an operating lease, then it is an investment property. If it's a finance lease, then it's not investment property, but that's maybe just complicating it too much. I think at this level, financial reporting, it would just be an operating lease. So you've got your land, you've got your buildings there to earn rentals. You're going to lease it out to somebody else. Or alternatively, you have land or a building that you have bought for speculative purposes. So there as capital appreciation. Hopefully, the land, the buildings will go up within value and you will sell them and therefore realize that gain quite quickly. Okay, because the housing market should be, fairly liquid, shouldn't it? Okay. There's just points to notes that the three things below are not investment property. So the first one there talks about the production of supply or supply of goods and services for administrative purposes. So effectively, if you've got land and buildings that you are using as your factory, your warehouse, your head offices, then that is for administrative purposes, isn't it? So you would deal with that land and buildings, that property under IS 16. Okay. So effectively that is owner occupied, isn't it? You own it, but you occupy it. Okay. You use it for admin purposes in your business. Okay. Also, just note there that if you are selling property in your ordinary course of business, so that's your day-to-day business, buying houses, selling houses, or buying land, selling land, then that's governed there by IS 2, because effectively that land and that building is inventory. It's goods that you are buying in order to sell in the normal course of business. Okay, so that fulfills the IS 2 definition. Likewise as well, if you have buildings that you are constructing for future use as an investment property, that is not IS 16 until it's completed. You follow the normal rules of IS 16 first, and then once it's complete, you then transfer it from PPE into investment property. Okay, so just keep a lookout for those scenarios. As I said, in this exam, it's not so much about identifying the IP, it's more about accounting for the IP. It's when you get to strategic business reporting, SBR, later in life, that you begin to look at the challenges in the identification. Okay. The good thing is that we follow this similar theme to what we've seen previously, in that we look at your initial measurement and then subsequent measurement. So initial measurement is very similar to what we have seen under IS 16. You measure it at your cost plus your directly attributable costs. Okay, so if you're buying land, maybe there is some stamp duty. If you've got some buildings, there might also be some form of building tax, purchase tax that is part of the cost. Okay, if that's irrecoverable, then it is capitalized. If it's recoverable, then it will not be capitalized. So there's nothing too extraordinary about that there. But the subsequent measurement is just a little bit where you need to pay attention, because you've got your normal cost model. You can choose this, but businesses tend not to. And what you do there is just follow IAS 16. Capitalize it at cost, depreciate it over its remaining useful life. Okay, obviously there will be no revaluation model. Okay, you just hold it at cost only. Okay, so you hold it at cost, depreciate it like anything else. Just note, if you are following the cost model, you should disclose the fair value, but that's a minor point at financial reporting level. Okay, because what you also have it is the preferred method being your fair value model, which when you think about it, you have this property for investment purposes. So therefore, you're going to look to sell it if it's there for capital appreciation. So therefore, why don't we recognize it at its most up-to-date value? Okay, which is therefore your fair value. So what we go through and do there is we revalue to fair value at each reporting date. So it's not like when we were in IAS 16 and adopted the revaluation model, whereby we revalued it when there was a material difference between fair value and the carrying value. Here, we take the fair value at each reporting date. Just note, this fair value doesn't have to be provided by an external valuer. We just need to follow the rules in IFRS 13 fair value to determine that fair value. No external valuation is required. The key thing that we have here is that your evaluation, whether it's a gain or whether it's a loss, is recognized immediately through profit or loss. Okay. None of this other comprehensive income for your gain, none of this through profit or loss for your losses, and maybe to OCI first if it's been previously revalued. If it goes up, it goes to profit or loss. If it goes down, it goes to profit or loss. Nice and simple. Okay. And therefore, just note, it will not be depreciated. Okay. So you just take the gain, take the loss immediately to profit or loss. Okay. There we go. Excellent. They're the rules. There are some additional rules before we go through and look at the example. Just note that we might move things in and out of investment property. So if there's a change of use, maybe you were leasing out a property under an operating lease, so it was investment property. So maybe it was some form of building, and now you've decided to occupy it yourself. Okay, so therefore it is now under IAS 16. What happens maybe if your business changes and instead of having your buildings as investment property, you now buy and sell buildings as part of the ordinary course of operations. So it now moves into IAS 2 territory. So if we're going from IP to IAS 16 or IP to inventory, you just take the fair value at the date of change. And again, under investment property rules, gains and losses at that date will go to profit or loss. Okay, there we go. And then once it's in there, that fair value now is the cost, if you like, for the owner occupied, and we will depreciate it. And then there for the inventory, that fair value is now the cost, and you would then compare that to the net realizable value to see what is the lower going forward. Okay, so that's going from IP to something different. What about the other way round? Okay, so it is owner occupied and you now transfer it into investment property. So you vacate your head office and lease it to somebody else under an operating lease. Okay, Chris, sorry about that. Interrupted by a phone call. Important one, all about Liverpool and the Champions League. So hopefully we can try and piece that together. What I'm going to do is I'll start from this bit here. So I may have spoken a little bit about that there, but finish it when I wrote gains, losses to profit or loss, and then drew that line under there. Okay, and then we can see where it matches up. Pardon me, sorry, excuse me. So what happens if we go the other way round? What happens if we have property that we own and occupy and are treating under IAS 16, so maybe our head office? And what happens if we decide to vacate the head office and rent it out to somebody else under an operating lease? So it is now under investment property. Well, the key bit on this scenario there is that we revalue it under IAS 16. So what that then means is that you will have your gains obviously go through there to OCI. If there are losses, remember under IAS 16, they will go to OCI first and then any excess to profit or loss. So it's just a normal IAS 16 treatment before it then gets transferred into investment property. Okay, and then that fair value becomes the fair value of the IP and movement up and down, gains, losses, profit or loss. Okay. If you've got your buildings that are as inventory, so used in your day-to-day operations, and you buy and sell those buildings or buy and sell the land, and then decide to change that to investment property, again, you take the fair value of the change and the gain or loss goes to profit or loss. Okay. Similar, if you like, to IS2 in the with IS2 you value at the lower of cost and NRV. Obviously, if the NRV is higher, you don't revalue it to its net realizable value because that's not prudent. But here we're transferring it into IP, so therefore we will treat it as IP on that data change in gains and losses to profit or loss. Okay, and then follow on with the same treatment. Okay. Strategic business reporting, maybe, but there goes. Okay, could be, maybe in F7. F7, I've said it. So close. Financial reporting, formerly known as F7. Let's just have a look. You know, it could be a bit of a multiple choice question or form part of a longer question in section C for your individual company accounts. So here it wants us to explain the treatment in the financial statements for the year ended December 15. Again, I'm not worried about the explanation. Explaining things is what you see normally within SBR. I'm focusing on financial reporting in this instance here, okay, which a lot of it is crunching the numbers, isn't it? So our year end is December of 2015. The financial statements are looking there at the statement of financial position and the statement of profit or loss and other comprehensive income. Okay. It says here, Adlington owns a property that it is using as its head office. So here, if we are using it as our head office, it is owner occupied and therefore IS 16, isn't it? December 2015. That's the start of the year when it was owner occupied. Its carrying value was 20 million and its remaining life was 20 years. So therefore we will depreciate that asset as PPE. So within the statement of profit or loss and other comprehensive income, there will be depreciation. How much? Well, 20 million over the 20 years. So is that $1 million per annum? But just note, on the 1st of July 2015, so halfway through the year, the business was reorganised and cheaper premises were found for use as a head office. It was therefore decided to lease the property under an operating lease. So what you have there is halfway through the year, it is now IAS 40 investment property. So what we've got there is that in my depreciation, it's there as the 20 million over the 10 years multiplied by, is it 6/12? Okay. So does that mean there that my depreciation is $500,000? Okay. Sorry, it was 20 years, wasn't it? Careful. Thought that just looked a bit odd as I was doing the arithmetic. 20 divided by 20 is the 1 million, and half of the 1 million is the 500,000. Phew. Good job I spotted that mistake. Otherwise, there'd have been all sorts of comments underneath on YouTube whereby I say, you got this wrong, you've got this wrong. I'm human. Okay, it happens. So you've got 500,000 there, $500,000 as your depreciation. Now we have investment property for the final 6 months of the year. Remember that investment property is remeasured to fair value at the end of the year. Okay. So what we've got there is it is now told that it is 21.6 million. So 21.6 million as IP. We need to be careful though as well, because I've just got the easy marks. Okay. I think getting the fair value is pretty easy. The depreciation is pretty straightforward. But what you've got to be careful of here is that, yes, there is a gain on investment property, which goes in the statement of profit or loss. But there is also, I think, a gain on PPE, which goes through other comprehensive income, doesn't it? Okay, that, as always, is going to be a bit of a challenge. So I'll leave that for a moment. Because more importantly, we were told that the data change, the fair value was 21 million. So there will be some gain that goes to OCI as we increase it from its carrying value upwards. But more importantly, it increased by 0.6 million by the end of the year. So that gain on investment property is the $600,000. Okay. Pretty straightforward, yeah? Not too bad. Let's do the hard bit, the working, the gain on PPE. So don't do anything different to what we've done previously. If we have a revaluation, we take our narrative, historic cost, revaluation, and then is it the reserve? Okay. So the narrative is that we have our carrying value. Was it at the start of the year? So the 1st of January 2015. And that carrying value at the start of the year was 20 million. The depreciation that we calculated was 500,000. Giving me a carrying value at, was it the 1st of July? 19,500. So that's the date of change. It was revalued up to, was it 21 million? So I can put in the 21,000 there. So I have, is it a gain? Is it of 1,500, or if you like, 1.5 million. Okay. That 1.5 million goes through OCI because we treat it under IAS 16 first and follow the normal rules. And then following on from that date to the end of the year, it's a gain on investment property, which goes through profit or loss. Okay. That investment property is then no longer depreciated once it has been classified as IP on the 1st of July 2015. Okay. There we go. That makes a great question as part of an exam, whether that's a multiple choice or whether it's there as a part of a financial statements preparation question in section C.